Okay, let's see if we can get through some questions from last week's market outlook. Curious to know if you ever get behind activist investors. Not really. If no, what's your take? I think they're useful. I think Bell Canada could use an activist investor. I think you need a change of management. That's usually what they're good for, is to say, look, you need to unlock value this way, and if you can't, you know, if the activist investor is well known enough, then it can start to get other investors interested in change, perhaps. Did you ever think of becoming an activist investor yourself? Not really. No, I don't really. I mean, I don't have the capital to get a big enough position in Bell to force them to change CEOs. I would have to, get involved in a proxy fight. I would have to advocate for a seat on the board. It would take a long process unless I raised a fund. I really have no interest in doing that. While we're on the topic, could you speak more about ways active investor could be a pain in the ass for management that won't listen? It's not my thing. I don't really know too much about all the tactics. I feel like these are not obvious mechanisms, but are interesting. For instance, take this filing. I'm not going to click on that and read it though. Engaged Capital had covered calls for Patillo, and they covered when the deal was reached to nominate a new board member. Tried asking LLM about this, but not convinced by their reasoning. Suggested that covered calls were used to signal that activist is still holding the stock. I don't think you need to sell calls to signal that. Does not believe in the current management to do a turnaround of the business. Maybe the cover call was just to simplify their structure ahead of formal cooperation with the company. Without knowing more about how this company does things, what their tactics are, what their motivation is, what their success rate is, what their previous history is, it, at first glance sounds like just a risk management technique. That's probably where I'd put it. I agree with your statement. Supply chain highly efficient. Last report from OECD supply chain resiliency, mentioning a decrease of global trade of 18%. Also mentioned that reshoring is going to provoke a loss of GDP for around 1 to 5% according to their scenario. Why reshoring domestic production is so risky. I don't know that I would say that it's risky. It's just more expensive. If it wasn't more expensive, that would have been the supply chain. These are not things that just come together by mistake. These are things that are thought about deeply and assessed by people with pages and pages of spreadsheets to make the right capital allocation decision. If it made sense to build a domestic production facility, they would have. That would be the supply chain. Critical mineral like graphite is available in China, but domestic processing could accelerate efficiency of production. Efficiency. Do you mean effectiveness of production? It could accelerate production. I don't know if it would be efficient because you're going to have to hire more expensive labor. You're going to have to build a facility with more expensive labor. So your capital investment is going to be much bigger than it would be in China, and to run that facility is going to be more expensive than it would be in China because you're going to have to use more expensive human beings. So it will be less efficient than China. It'll be a worse allocation of resources than China. So you are getting inefficiency in the capital allocation process, but it would be effective in the sense that, yeah, we could produce it. Burning down your house to get rid of termites is effective. It's not very efficient. Someone once say Trump portrays what a 9-year-old thinks a smart, rich, successful guy. Well, I think that's more of a warped view of what a 9-year-old thinks a rich, smart guy is than Trump trying to impress a 9-year-old. My Trump model for market simply asks, would this impress a 9-year-old? If yes, then bullish. Why? Why would it be bullish if it impresses a 9-year-old? If no or too complex and bearish, if my model is accurate, what does it say about the active component of the market leading passive? I don't think active is leading passive at all. Is the market being led by a cohort with the sophistication of a 9-year-old? No, I wouldn't say that. The market is highly passive right now, and I think what is driving the market is we are entering a hype cycle. We are deep in the boom cycle of AI, and you're already hearing the hype. The hype cycle is all the stories about what the future is going to be. And every week that goes by, that story gets bigger and bigger and bolder, and it covers more ground. And it's not just this or 10% of that'll change. It's 30% that'll change. Then it's 50%. And Vinod Khosla came out a couple days ago, said it's 80% of jobs that'll be eliminated. Actually, he said 80% of all jobs could be done with AI. So by 2040, people will not need to work. He said people will pursue what they want to pursue, not because they have to, but because they want to as well. Who's going to pay them? Where are they going to get the money? But you see, the story's just going to get bigger and bigger and bigger. That's the hype cycle. I think that's what's driving the market right now. You mentioned being long IWM in part because of more reasonable valuations. What metrics do you use to come to this conclusion? My understanding is that Russell 2000 has a trailing PE of 32, forward of 27. PE published on iShares website about 17, excludes unprofitable companies, as it should. As it should. So let me give you the reason why. Let's say here's the Russell 2000. Now it has, I think, one of the highest shares of unprofitable companies, somewhere around 45%. So let's say it's 40%. And it has a certain price. Well, if you just take the profitable companies and you look at the forward multiple on this, it obviously would be with this price, and you get 17. So I say to you, you're paying for these companies at 17 times when you pay this price. And what I'll do is I'll throw in these for free, right? Because they're not included. 17 is the profitable companies. And that's the price you pay. So if you think, well, if we just erased all of these, let's just get rid of them altogether. Let's just take the index and just get rid of them, but the price won't change. You'd be at 17 times forward earnings. You'd say, okay, that's not bad. And then I say to you, I'll tell you what, I'll throw these in for free. You would look at that and say, what if they go to zero? I say, I threw them in for free. I'm just giving them to you. There you go. So that's what makes it such a great, I think, a great target right now at these valuations, is because you are paying for the profitable companies when you pay the price of the index, and you get all the unprofitable companies thrown in for free. As people get older, reaching higher age of 60, cognitive abilities or even intelligence, ability to stay current or even to have much of their expectations future is likely to decline. So let's think about, let's just think about age. Actually, we'll put age over here, and we'll put cognitive ability over here. And throughout life, yeah, as you get to a certain age, it starts to decline, right? But at this age, what you see over here is the middle of a distribution. At this age, what you see right here is the middle of a distribution. So if we think about it this way, this is sort of the middle of a distribution. And I've just flipped this around. This is the right tail. This is the left tail. I've just flipped it around like this. It's not necessarily true that you would, just the average does. This is fairly normal, because the average in the population retires. They stop thinking every day. Use it or lose it, right? So they tend to stay with the same stories. They tend to stay with the same jokes. They have told it so many times in their life, they forget who they told things to. So, they end up telling you the same stories again and again. But for the middle part of the distribution, yeah, as time goes on. But keep in mind that if you talked to the whole left tail over here, you would say, wow, okay, I can't even talk to this person. So you couldn't even talk to them in normal times when they were like, let's say 40 years old. You would think, I can't even talk to these people. That, when you see them later on from standing over here looking this way, keep in mind that you could have evaluated them the same way here. So when we say suffer from cognitive decline, you're talking on average. If you're in the right tail and you're actively using your mind all the time, there's no reason why you would suffer cognitive decline. It's when you give up and you stop using it. How do you think what one needs to do or expected to do, he or she will eliminate or at least mitigate such cases as they age, let's say 60 plus? Just use it. Use your brain. Keep using it. What are your thoughts on the stablecoin bill that was passed? I hope you get more specific than that. Do you think this will speed up the adoption of stablecoins? Well, yeah, I think so. In the places where it matters, I think it will, sure. I see Walmart, Amazon, JP Morgan planning to have their own stablecoin, and they seem to want to undercut credit card companies by using alternative payment methods to avoid paying fees. Yeah. Also feels like the founding principles of crypto, decentralized, permissionless, and open source, is being let go as individual companies introduce their own tokens. There are thousands of tokens out there. Trump has his own token. I don't know that this is an issue. You have permissioned, right, and permissionless. If you have permissionless, you need a token to get that done. If you have permission, you don't need a token. The token is just a way of saying, how do I get a physical US dollar over to this person over here? Well, going through the system is what everyone is saying. Well, this is what has the costs and the delay. We'll just put time over here. Well, is there anything that this blockchain business can do, right? Anything that this blockchain, but I really don't want to give up a trusted third party. I want my trusted third party involved. I can send a token along this, but the tokens have this kind of price nonsense that does this, that by the time it starts and gets here and the other side converts it, maybe it started at one price and it ends at another price, or it goes up to here. It's too volatile. Give me something stable. Give me a stable coin. You got it? So the stable coin, think about it as the vehicle. That's just the vehicle. And what is the cargo in this vehicle? US dollars. So you take your US dollars, you put it in the trunk of this vehicle. This vehicle drives across here and hands it over to there. That's all it is. It's just, you don't own it for its own sake. You don't own it because it's a meme coin or you think it's going to the moon. With no users, it's going to the moon. You use it because it is a vehicle to send $1 US or €1 from one location to another location without any loss of value. And with a trusted third party standing behind this coin with US treasuries to fully back it, so that when this group of people say, okay, I want to turn it into dollars, there are dollars that exist to get that done. So it's not a token, it's a vehicle. Well, now that starts to have use. What are the potential risks of front-loading issuance in the short-term T-bills? Well, you just got to roll them over all the time. I don't know that I would think that there were any risks. You just got to roll them over a lot. How will it impact long-term inflation outlook? Why would it impact long-term inflation? I don't understand that. Dollar strength. Where on the yield curve money goes doesn't affect US dollar strength. It is the interest rate differential that affects the dollar primarily. So I don't see that. Fed credibility. It's the Treasury that would be issuing bonds, not the Fed. The Fed has nothing to do with the issuance of bonds. The Fed has nothing to do with what size the 10-year auction will be, or how much is sold in 3-month or 6-month bills. Nothing at all. The Fed is about the overnight rate, and that's it. So I don't see the pathway, the causal pathway to long-term inflation from issuing T-bills. I don't see it in terms of dollar strength or Fed credibility. So I'm going to say it has nothing to do with any of it. Devaluing of the dollar won't earnings of U.S. companies, especially those that derive a large portion of their income overseas, appreciate in dollar terms? Yep, leading to an increase in earnings just from the FX gain. Yeah, it will, and that's usually reported, that net income was higher because of the translation on the income statement. However, you have a balance sheet with assets and liabilities. Assets tend to be non-monetary. And you have some monetary assets, especially in subsidiaries, because usually the cash flows up to the parent. So you do have some monetary assets. However, all your liabilities tend to be monetary. All right? And you have to translate these at the lower rate. So depending on the mix of type of assets that you have on your balance sheet, it could be that you end up with a balance sheet translation loss. I mean, I don't know. I'd have to see a balance sheet to determine whether or not there'd be a translation loss. So even though the income statement would show a gain, since this shows up in a separate part of equity, equity might take it away. There might be no change in equity. There might be an increase. There might be a decrease. I don't know, but you don't just translate the income statement. You have to translate the balance sheet as well. Typically, on the income statement, foreign revenues, and if the margins stay about the same period over period, it does lead to an increase in net income in domestic dollars. Could we explore the methodological foundations of current exchange rate policy in light of current USD dynamics? I'm going to need you to give me a smaller question than that. The Trump administration appears to be using RER analysis. That's, well, it's a real effective, there it is, thank you, brain, real effective exchange rate analysis to justify USD weakening policies. So that's just inflation differentials. Academics have criticized RER efficiency and unbiasedness result versus PPP. Oh, wow. Okay, here's a dividing line. Here are the academic critics. Here are the academic supporters. Give me any economic argument, and I'll find critics and supporters. So to say that academics have criticized it, give me any financial theory, efficient market hypotheses. Academics have criticized it. CapM, academics have criticized it. Fama French, academics have criticized it. There's always academics criticizing something somewhere. So, if you are trying to build an argument against something, it's easy to find a group of academics who have criticized it. So that's not saying much. How should we evaluate the soundness of policies predicated on RER-based misalignment assessments? I don't know what you mean by that. What could be the implication on the long term? Who the hell knows? I don't know. This is a complex system. Beats the hell out of me. I wouldn't even get in that deep in the weeds. The market is not going to get that deep in the weeds. The market thinks the U.S. dollar is going down. Be happy with that. I mean, who cares? Who cares what argument the administration is bringing out? And besides, the argument is an afterthought. The strategy is the thought. We want a weaker dollar. Find me an argument. Oh, well, we're overvalued based on something. And then some people will come out and say, well, there's lots of academic support for this. And then those who are against it say, oh, academics have criticized this. Blah, 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 blah. Who cares? What is the U.S. dollar doing? It is going down. Well, position yourself for that, because I think you're going to have probably more weakness. At the beginning of the year, I said I expect dollar strength for a while and then weakness, and we certainly have the weakness. So I don't know that that's going to change anytime soon. I don't care why it's weakening. I don't care about the academic debate. I don't care about any of that because it's not useful. So I guess I guess there's your answer. As soon as somebody says academics have criticized, I say, yeah, but academics have supported. For every critic you find, I'll find a supporter. It's easy to do in academics. Where do we leave off? Would you expect those cognitive domain emulators, all those Gemini, Chat GPT, and other chatbots, eventually reaching higher levels of learning at metacognitive levels in the next 15 to 20? Oh wow, 15 to 25. I have no idea. I'm not on the current architecture, but I don't know what architecture is going to come out next. I don't know what quantum computing will be able to deliver in terms of that. So in the next 15 to 25 years, I'm certainly, in the next 5 years, I would say I'm leaning more towards no. On the current architecture, I'm leaning very heavily towards no. No, not at all. If there's a different architecture, then sure, 15 to 25 years, I don't know, flip a coin, right? That's way too far in the future. If this were 2010, and I said, tell me about 2025, will we have, will AI be able to replace 50% of the jobs out there? That would have been a hard guess. It's like, well, I don't know, will robots be walking among us in 2010? You would have had some people saying, yeah, some people saying no. Well, it's kind of like a, not really, but kinda. So in 25 years, maybe, kinda. I know that's not a good answer, but it's just too far in the future. First time I think I found a counterpoint. You once said there shouldn't be a maturity premium for treasuries since such a liquid market. What about duration risk? That's not a maturity premium. That is just a premium for interest rate risk. Sure, longer dated securities should have a higher yield for nothing more than the interest rate risk. A maturity premium is saying that a 10-year, by the same issuer, a 10-year bond should yield a premium just because you're locking up your money for 10 years as opposed to 5 years. Now, in private credit, that might make sense. But in a very liquid market like treasuries, there should be zero maturity premium in the sense of it's 10 years, not 5 years, so I want more. If you say, well, it has a higher duration than a 5-year does, well, then maybe I want more, maybe I want less. It depends on my expectation for long-term interest rate volatility. If I think long-term interest rate volatility will be low, but short-term interest rate volatility will be high, I may be willing to pay a higher price for the longer bond, accept the lower yield because I expect lower volatility in the longer term. So you have a yield curve, right? And let's say this is the 5-year and this is the 10-year. And I'm expecting some volatility that will just simply die down. Well, since the majority of my cash flow is over here, I have some structural risk here, but no structural risk here. These may get bid up in price so that the yield curve starts to flatten because we expect most of the volatility to be at the front of the curve and a lot more stability at the back end of the curve. That's fine. But a maturity premium suggests that even without any kind of other risk involved, that just lending money longer should have some kind of difference in the premium. Whether at the 5-year you're saying, well, 10 basis points is maturity, so at the 10-year maybe I want 17 basis points. There's an extra 7 basis points for nothing more than the fact that, well, it's 10 years, not 5. And then you'll start building in your other premiums for the type of risk that you expect to happen over that time. I don't think there should be any maturity premium. On tariffs and deals. Deals. We got okay, deals. Trump has changed his tune lately to deals are not important because every country is begging to trade with the US and he will unilaterally dictate the tariffs. Yeah, it's not working out for him, so just change the rules of the game. 90 deals in 90 days. And you had the UK. Today you had Vietnam. There's two. And it's the 2nd. And we have 6 days left to the 8th. That's a pace of 13 deals announced every single day for the next 6 days. Not going to happen. So he sees it's not going to happen. So rather than looking like a loser, which, none of this is coming together the way he thought, just make a statement that's different. Oh, I wasn't interested in that anyways. Hey, I heard Debbie turned you down when you asked her out. Yeah, I really wasn't that interested anyways. Do you know what I mean? Like that's a statement that kind of just protects my own ego, right? So, do you honestly think that at any point in time Trump will come out and say, well, we lost on that one. I was wrong and I lost on that one. He's never wrong. Somebody else messed up. He'll just blame someone else. Someone will take the blame for this kind of stuff. Do you think that this is a more likely scenario than another 90-day pause? Well, you called him a chicken. The market called him a chicken. And I've been stressing that we really should be thinking about the ego trade. Not the taco trade, but the ego trade. He will burn the place down to save his ego, right? He will burn it down. So the euphoria in the market, I don't understand it. Even today, Tesla reported their largest drop in sales, and up they go. ADP says we lost 33,000 jobs, and up the market goes. Vietnam will now pay at least 20% tariffs. That's not 20%. It starts at 20%, and up the market goes. Doesn't give a shit. Just doesn't give a shit. So I think that the hype cycle for AI is far, far too powerful right now. Nothing is going to take this down. This market's bulletproof. If jobs report comes out tomorrow and you have like negative 150, I'm just making that number up, you'll see the S&P do this, and then who cares? Who cares? Who cares? Who cares? Even if Trump says 80% tariffs across the board, you'll get this and you'll get this. Well, I don't know about 80%, but I don't know what takes this market down. So who cares about a pause? Who cares if he announces things? Don't you know he's winning? Don't you know it'll be, whatever he announces will be the greatest ever? Blah, you know the routine. I don't have to repeat it every time, but you know the text. It's cut and paste, cut and paste. And I think the market has just gotten tired of the bluster. They know it's bluster. And at this point, it's probably more than likely that most countries will elect to wait Trump out 18 months. Why would I agree to anything? You want to hit me with tariffs? Hit me with tariffs. I'll call you all the wonderful names you want, and I'll promise to enter into some trade negotiations, and I'll try to get it as low as possible, but I'm not going to do anything. I'm not doing it. And this will amount to nothing, I think. Let's see. The market being at all-time highs combined with the knowledge of Taco makes me believe that this is more likely. Could be a subdued version of that Excel chart. Wanted to get your opinion on initial claims and how it's been increasing recently. I know you said this is something that might reflect weakness in the labor market. Charted NSA and SA, non-seasonally adjusted, seasonally adjusted. Over the past few years, excluding COVID, seems like initial claims are behaving as they should in a normal labor market. Yeah, they're behaving as I think if you look back over a different period of time, you'd find that, wow, it's really nothing here. So it's not so much, hey, when you're looking at a chart saying, I looked at this period of time and the level was over here. I'm looking at this period of time and the level is over here. It looks the same, but it did this and now it's doing this. So it's not the level, it's the speed of the direction up to the level, because it doesn't just hit this level and then decide to do this. If it's doing this, it tends to continue on. So you have to look at the trajectory and the time it took to get there. It doesn't just stop at that level and then continue on, right? So let's see what else we have here. Non-seasonally adjusted data says the labor market is behaving normally. Seasonally adjusted data is a little more worrying, and it had increased in the previous quarter more than previous seasonality would allow it to. Okay, so you're catching on there. Statistical distortions like this is better stick to the non-seasonally adjusted data. No, you can't pick and choose. You gotta stick with what you want. So let me explain why you'd always stay with seasonally adjusted data. Let's say we have a timeline here. Let's say this is May, June, July, and August, and we'll put September in here. And you have job, if you're looking at non-seasonally adjusted, if you could, you're doing a good sample and you're looking at non-seasonally adjusted, which means you're counting the raw numbers, and you see something like this, right? Well, this is all the students, college and university students that are taking their summer jobs, and now they're going back to school, right? And they're going back to school. So if you looked at non-seasonally adjusted over the month of May, and for June, you'd say, whoa, the economy is on fire. And then in September, you'd say, whoa, man, we are in trouble here. So you want to compare it against every year that you've done this. Well, let's put out 2 years. Let's say we have 1 year that does this. And let's say you have another year that does this. Now, if you're looking at non-seasonally adjusted, you're saying, I don't see the problem. We're creating jobs. You get that? And you'd be losing jobs over here. But look at what the normal level is. Hey, we're creating jobs, but you're way below the normal level. So the economy on this bottom line is producing fewer jobs than the economy on this blue line. If you're producing fewer jobs, the economy is sort of losing the potential of those jobs. So it is, in essence, losing jobs if you seasonally adjust, which is what you need to do, because if you don't, it would appear that you're creating jobs. Here, it would be above the seasonal adjustment. So here we have job creation. That's a very good economy. So you do have to take that into consideration. Which one would you say has better explanatory power and why? Seasonally adjusted. How do you read seasonally adjusted data in general? I just gave, I think, a good example. I understand you have a residential house in Costa Rica. I do. It appears to me when it comes to residential house in emerging markets, like Costa Rica or lower frontier markets where rule of law is not well established or weak, purchase of the house in those markets seems to be suboptimal to renting, since there is a fair bet that the day will come the government of those markets may threaten house owners with unexpected environment or landscape changes. You're saying it's a fair bet. So you're suggesting that is going to be not a risk with a probability, but a fair bet. So the odds are equal. Or what you're saying on that? I disagree with the odds being equal on that. I don't think so. Would it have been better to rent or buy? Well, with renting, you don't have to put out a lot of money. Property in third world countries like that are rather illiquid. The moment you move in, you must put it up for sale, because it usually takes 5, 6, 7 years to sell a property. So when you move in, you immediately list it for sale. Not that you care to sell it, but if somebody comes along and pays you 10 or 15% more than you just paid, you'll take it. But you have no interest in selling it. But you can't just list it when you decide to sell it. It takes a long time to sell a house. So you have to be open to it at all times, because it can take up to 6 years. While I own it, I Airbnb it. All right, so I do generate revenue from that, which pays for the running costs of the house. and then reinvestment. So it does allow me to put more money into the house to upgrade it. So there are 8 stables on the property. The previous owner took their horses out. The stables have been empty since. 2 have been put back into shape because they don't deteriorate over time. They just, if they're not lived in and cared for, they tend to need a bit of work. 2 being put back into shape, so 2 horses are coming in sometime in July or early August. And that's all paid for by Airbnb, right? So it allows you to create almost a resort place. And then I go down there. So it's all right. I don't mind it. The purpose that I bought it for, renting. No, actually, I couldn't rent. I would have to buy, and at least I think it's $280,000. But I could have bought a $280,000 condo, and then I only have to be there for 20 days. Had I known at the time, had I had a better lawyer who told me that, I would have gone this way as opposed to buying. But there is a general rule in investments. If you have an asset and the asset is not working out, you immediately engage in risk management. Airbnb is my risk management. If Airbnb doesn't work out, then you engage in risk elimination, right? Which means you sell it at whatever price you can get. You move it fast. And if you lower your price, you don't have to wait 6 years. And, we do this with equities, with stock. You buy ABC. ABC doesn't perform, it drops. You say, okay, I'm out. I'm cutting my losses. This is the same thing. So this is risk management. You could say I'm selling calls on it because other people get to live in it for 3 days at a time, 5 days at a time. So, it's like it's theirs for the 3 or 5 days. So I'm selling part of the distribution of ownership a little at a time. So every month I'm selling. You can think of Airbnb as covered calls on your house. So it is risk management. And the extra money goes into upgrading the property. Once the horses are in, the price for Airbnb goes up $100 a night. And we're booked about, I'd say about 120 to 130 nights a year, about 33% of the time. And that doesn't sound like a lot, but it's still generating profit at that. So if you look at Airbnb and you look at the house that I have, you'll see it's highly rated. It's called a guest favorite, and our booking rate is getting better and better. So at $100 a night, you're looking at another $12,000 to $13,000 a year, which more than covers off the cost of the horses being there. So they become a revenue generator as well. Renting appears to be much of a safe haven in case something significant. Well, if you're renting, you can only be in the country for so long. You have to, unless you're a resident, you're going to have to leave that country, right? So you're not going to rent in a place like that. You'll just use Airbnb. And Airbnb has longer term rentals, but let me tell you something. You get the wrong neighborhood in that country, you are not going to enjoy yourself. I can tell you that right now. Why can't you look at operating cash flow if they mostly expense the IP through the income statement, since it would reflect there and not in Capex, thus it wouldn't reflect in CFO before free cash flow? Can't really do that, really, because it is not what you did over the last year, is what you're going to do into the future. So you have to look at Capex going forward, what the level of Capex is going to be. So you do have your CFO, and if you have on your income statement expensed much of your stuff, your net income is your first line. You make all your adjustments. You have your cash flow from operations. Then you have your investment side, and there'll be a Capex spend in here. This is a little bit difficult to pull apart because you think, well, this Capex, typically we think about it as going to the balance sheet, but if it's for internally generated IP, the spend will be in here, but much of this Capex is still going to hit the income statement, and Capex, if you look at it over time, is doing this. You have no choice but to keep going. This is a Red Queen effect, right? One company says, we're going to spend $10 billion. Well, then everybody's got to spend $10 billion. And if you think about it from a game theoretic point of view, if you're the only company that's not, you may as well just stop because you're not going to be able to play this game. You're going to be done. So you got to spend 10 billion. Well, if everybody's spending 10 billion, that doesn't give me an advantage. I better spend 50 billion. Well, then I better spend 50 billion. Well, then I better spend 50 billion. Right? And if it'll keep increasing until, well, I can't spend 50 billion. And if you can only spend 30 billion, it might not even be worth trying. Right? Because I'm at the point now where, I use Gemini. I have Claude, but I find Claude, for what I do, completely useless. I don't need a model that's almost as good. When I have a model like Gemini, when I use Gemini and the family of models there, I don't need to pay for another service that's almost as good. Either it's better or I'm good where I am. But I don't need five different companies where I say, well, this is almost as good. No, I'm out. So you got to spend more money. So it's not a question of the amount of money that they have spent in the last year. It's how much is lying ahead of them just to play this game theory that's unfolding, where you have no choice. Spending becomes a necessity if everyone else is doing it. Because if one company gets to this Valhalla place of AGI, it's over for everybody else, because they will get the entire market. It is over. So all the billions of dollars that you've invested are worthless. It's all gone. So yeah, maybe that helps answer the question. On student loans, wouldn't it be a relatively bad outcome for the economy if government starts seizing assets? And I think they are able to. I don't know about seizing assets, but they can garnish your wages. Part of the paychecks of those in default. Yep, mind you, they're not likely high earners, but at the margin, this could lead to lower consumption, further weakening the C in GDP. Yeah. But garnishing wages, I believe you're limited to 15% of the wage, at a maximum 15%. But yeah. The other side of that is, somebody did lend the government money in a bond to lend these people money. So if you don't get the money out of them, then the government has to pay for the whole thing themselves, which means they have to extract more tax dollars from some other part of the economy to get it. So either all these people pay back their student loans, or they don't pay back their student loans, and let's just assume the government doesn't garnish any of their wages, then the government's going to have to get that money from other parts of the economy, from other taxpayers, from service fees somewhere, from higher interest rates on other borrowers. So somebody's going to pay for it. May as well be these people, right? Can you talk more about video and going the way of Cisco? I thought your diagram going through the AA market was very good, but you didn't expand on that NVIDIA comment until the end when you said its chart was going to look like Cisco's. Yeah. So if we look at, and if you're questioning my credentials on this, you can look up my PhD. It's called Finding Fertile Time. And you'll see that there's a whole chapter on the history of technology. And all technology follows this. All technology follows S-curves. There is no technology that has done this. None. Let me say that again. None. There have been, I guess you could call it a family of products that have continued on like this. So you can think, well, TVs have done that. Well, not really, because you had tube-based TVs, followed by plasma TVs, followed by LCD TVs, followed by OLED TVs, and who knows where it's going to go. But the technology in them has changed over time, making it look like TVs were on a trajectory, but all these tube making TVs, they're gone. All of these plasma making TV companies, they're gone. All of these LED companies, maybe they migrated to OLED, but they're gone. So if you tie yourself to a particular technology in making your product, you will get obsolete. Here is your LLM. It's just that simple. That is what it's going to be. Now, I want you to imagine the internet without the added layers. Imagine social media never came around. We'd be over here on the internet. Its productivity and its usefulness would be there for us, but 5 years later we could say it hasn't really changed much over the last 5 years, has it? But what changed it was the idea of social media, which brought it to a whole new level of productivity. Well, now you have LLMs and LRMs, which you can see as another layer to the internet. Think of them more like an operating system where they can bring you to an even higher level of productivity, making it look like, well, look, it's technology has an upward trajectory, but with changing and obsoleting technology all the time. So this was the idea of the internet at the time, is that it was a new way of potentially communicating, because you could do email. It was a new way of socialization because there were chat rooms that you can go into. A new way of perhaps commerce. That was the big idea behind it, was commerce, because you could just go to a website and buy books. Right? That was neat. And then they were just delivered to your house. Wow, look at what we can get done. So that was the basis of the explosion of investment going into the internet protocol at the time. Now, if we stay with this, that is called a technological S-curve. All technologies follow an S-curve. You have years of research, you have a breakthrough discovery, and off it goes. And the danger is that you start projecting this, and it always does this. So what happens is you get this breakthrough technology and you get this acceleration. You begin the boom phase. And the boom phase continues on, you get the hype phase. And the hype phase starts telling you what a future it's going to be, and it's going to be decades, and by 2030 it will be this, by 2035, by 2040 no one will have jobs, no one will have to work, it'll be Valhalla, heaven on earth, the robots will do all the work, bring home the paycheck, it's going to be wonderful. We're in the hype cycle. Then you get disillusionment. And it always goes along with the S-curve. The disillusionment is, hang on a second, these companies aren't really making any money. All these thousands of companies with all these models. Where are the robots? They're not here yet. Aren't we supposed to have robots? This is the LLM, by the way. And it's really, as each new model comes out, it's just slightly incrementally better. I thought we were going to be here, but now we're here. And then we're supposed to be over here, but now we're here. We're going this way. There's the disillusionment phase. And that's what happened to the internet. Is you had the boom, you had the hype cycle, that was 99, 2000, right? The boom in investment happened sooner. By 95, people were talking about the internet. I remember somebody approached me to set up an internet service provider. I didn't like the idea because at the time I said, what if we do this? Let's rent all these lines from Bell. We'll put all these modems in this room. We'll do this. What's stopping Bell from doing this? Oh, Bell doesn't want to do it. They don't want. Yes, they do. Yes, they do. And they did. So we are, I'd say, about here. We're well into the boom phase and we're entering the hype phase. This is where investment just rushes in. And look at the VC space. They're pretty much investing in nothing but this stuff. Another website passed by my search today called Flora. You go to Flora and you can describe a picture. It gives you a picture, and then you could just draw a line to something and say, give me a video. Very little description going on. Doesn't really work that well. Right at the top of their site, just secured 5.5 million in VC funding. There are thousands of these models across the world. One doing this, one doing law, one doing x-ray, this one's doing shoe sizing, this one's doing, you can give it a picture of the room in your house, and you can start experimenting with all sorts of decorations, and it'll change the look of the room, and you can look at it in they're just everywhere. None of them making any money. But it's this super amount of investment that goes on. You're going to have chips after chips after chips after chips after chips, and then when you get to the disillusionment, these thousands will start failing. Well, maybe they had 300 servers. Maybe this one over here had 20,000 servers. This one over here had 35,000 servers. The amount of capacity that you have sitting out there at that point in time, so that if a new model, a developer comes along, there's so much capacity, unused capacity. They don't have to buy anything new. Whole bunch of capacity. And that's what happens, is the infrastructure build out required to support the hype cycle and the investment boom. You end up building out so much infrastructure, and this never happens. It always does this. Now, AI will do this over time, but there'll be a different technology that comes in that then takes it higher, and then that will be obsoleted by another type of architecture that takes it higher. But the LLM, the language model, and the reasoning models that are built on it will follow an S-curve. I will bet almost anything on that, because it's 100% accurate. If you look at every instance in history, it has a 100% track record, and this will be no different. So, where are we here? Is you're thinking that the demand for GPUs will be much lower going into the future, and due to being able to do enough with less? No, I don't think it has anything to do with doing much with less. We're entering that hype cycle now. And you're in the hype cycle when everyone's talking about it, and the future just can't get big enough. It just can't get big enough. Every week the future's bigger than what you thought it was last week. More jobs will be killed than you thought would be killed last week, and it just keeps going like that, and it gets bigger and bigger. And the story, because you can make up any story you want about the future, right? And people will believe it. Yeah, because it's believable, it's plausible. So if it's plausible, a large part of the population will confuse that with probable, and a large part of the population will confuse that with it's absolutely going to happen, right? And then the disillusionment sets in. How long is the hype cycle before disillusionment? No idea. But that is where we are now. You can't turn anywhere without seeing AI somewhere, without a new AI model showing up, 2 or 3. Go on Google and just type in AI videos and sit back. There's probably more AI videos out there than there are Excel tutorial videos at this point in time. Like, an unbelievable amount that are out there. Even if the latter is the case, the latter is the case, wouldn't the addressable market still be the same? Just more concentrated to whatever the popular model ends up being? No, again, it's the overinvestment that will create the capacity. NVIDIA is also not in the profitability situation that you point out for the rest of the A models. Well, neither was Cisco, neither was Dell, neither was AOL, neither was Microsoft, neither was Sun Microsystems. These were all the backbone of the internet. They were all highly profitable. Neither was Intel. Intel, you needed computers everywhere. Well, Intel was the thing. And if you had this internet thing going on, well, consumers wanted in on it. Well, now they needed computers. I mean, it was just a big infrastructure boom everywhere. And then it all, the acceleration of the hardware dropped the price considerably, and the market just got flooded with this stuff. But they were all profitable businesses. It wasn't as if Cisco was losing money. Sun Microsystems wasn't losing money. Microsoft wasn't losing money. Even Apple wasn't losing money. Well, I don't know. Was Apple profitable at that time? But all the companies that were involved in it, the telecoms were just printing money, printing debt at the same time, but they couldn't expand fast enough. And the stories just kept getting bigger and bigger and bigger every day. It was never going to end. There were never going to be malls again. You had to be around at the time to hear the story. There were virtual malls online. So you could go to a website and it was a virtual mall, and you can click on whatever store you wanted to go visit. And websites were rushing to the internet to get into one of these virtual stores so that they can rent space in the virtual store in this virtual mall. And there were virtual malls all over the place, and everyone thought, well, rather than going to a mall and finding Saks in this mall and Saks in this mall and Saks in this mall and Saks, they'd be in 55 virtual malls all around the world. And they could set up overnight, and who's ever going to go to a mall again? And none of that ended up being true for even 25 years later. The majority of shopping and buying still happens in stores. And we're 25, 26 years past that hype cycle, and we're still not anywhere near the hype. I think it'll be the same thing for the LLMs. I remember that year. It was just a wild year. It was just an unbelievable year. Everyone was talking about it. Even your neighbor, was talking about the latest IPO. 2, 3 .coms IPOing every day. The time from a VC investment to IPO sometimes was 6 weeks. It was ridiculous. It was just a mad gold rush. And then in early 2000, by March of 2000, the disillusionment phase started setting in with, okay, none of these companies are making any money. They're all burning through cash. All of them burning through cash. OpenAI, cash burn. XAI, cash burn. If you look within the companies that are doing, forget it, Anthropic, cash burn. Perplexity, cash burn. Manus, cash burn. DeepSeek, cash burn. Look within Google to Gemini, cash burn. They're all burning cash. And there's, 2 companies, Meta and Google, that have models within it. And the company as a whole are profitable. But go through all the others. Burn. XAI announced they were going through $1 billion a month. Burn. All the thousands of small little models. All the thousands that are out there. All of them. Burn. You see where I'm going with this? It's all cash burn right now. And every day around the world, I would say conservatively, there's probably a dozen AI companies being venture funded every single day around the world, every single day. And those are ones that are being funded by VC. There's probably 4 times that number that are unfunded, that are out there building, waiting in the pipeline to be funded. I remember you've talked a lot about the levels of learning from recall all the way to creation. Do you think, okay, missing a word, do you think there is certain assessment tests to determine, at least broadly provide very approximate learning level of a person? For example, test assessment to determine if the person has metacognitive level of learning or not. I think demonstration of, passing certain milestones. I think it'd be difficult to get out of a tier 1 university without having developed those skills. Passing level 3 of the CFA is probably a good indication that you've developed some skill there. If I say something like, my truck won't fit in my garage. I'll just put G because it is too big. What does big refer to? My truck won't fit in my garage because it is too big. You would say, well, big relates to truck. Well, what if I say it's too small? You would immediately say, well, small must refer to the garage. It's the only thing that makes sense. You would not believe how much difficulty LLMs have with that, with being able to switch that quickly. Just they change one word and they switch the association between the adjective and the noun, change one word and to be able to switch. They have such a hard time doing that. So, I mean, if you could easily switch in your mind has the ability to think at a different level than they have. If I say to you, if you're doing something and I say to you, look, you're doing this wrong, you have to sort of do it this way, and you say, oh, okay, I see, and then you start doing it and you're doing it right. It means you have the ability to accept feedback, reflect on your work, and change your work. LLMs have a very hard time with that. Even when you tell them what they're doing wrong and you ask them to do it again, if it's at a level of analysis, they have a very difficult time with that. I have a difficult time getting them at that level. And even when I look at the output, I go, no, you're still missing the point. But I can't say to them, hey, you're missing the point. I have to say it in words such that they can pattern match. And once they pattern match, they don't have a separate independent mind that can reflect on things and go, I get it now. Not unless they can pattern match the words, I get it now. Would they know how to do that? And they still wouldn't even understand what it meant to say, I get it now. Getting through certain things, certain milestones, I think gets you there. If you can look at a point of view and you can argue both sides, I would say that you probably are a good candidate for having metacognitive skills. But if you can't see the other side of an argument, if you can never make the other side, probably not. Do you use the Kelly criterion in position sizing? No. Yes and no. Do I use the math? Do I break out the math? No. But there's a certain logic behind it that says if you are random, your size should be 0. Random means that you're right 50% of the time and you're wrong 50% of the time. When you're right, you make $100. When you're wrong, you lose $100. If you're right half the time and you make 100 and you're wrong half the time and you lose 100, you just shouldn't be doing this. So what is it suggesting? It's saying there are two things as an investor or trader that you really need to focus on. This and this. That's it. So what it's useful for, and I think its elegance comes in its parsimony. Not so much its precision, but its parsimony, because it brings your job down to two things. I gotta be right more than I am wrong. Simple as that. And when I'm right, I gotta win more than I lose when I'm wrong. That's it. That's what it brings it down to. So you think, how do I increase the probability that I'm right? Well, that requires reflection. You have to look at all the trades you've done and you'd say, okay, well, when I'm right, why was I right? And when I'm wrong, why was I wrong? You may find out that, well, when I'm right, it's because I stick with what I know. And when I'm wrong, it's because I listen to Kramer or I listen to someone else saying, oh, you got to buy this. And I do, and I don't even understand what I'm buying. So, okay, well, then it's a matter of education, right? Expose yourself to more. And the more you learn about different sectors, different companies, different industries, different relationships, the more you can increase this over this. What about this over here? Well, this is risk management. All right? So education will give you the what. What should I buy? Learning risk management will say how. How should I hold it? What should I do? And the goal is, when you're wrong, is to have this number, on average, lower than this number. So let's just run through an example. And that's really, if you can take that away, yeah, I'd ignore the math because it is a really simple formula, but in the end, it is just the spirit of it that I completely agree with because it brings it down to two things that you have to do. Get education so that you're right more than you're wrong, or at least stay away from shit you don't understand, right? And play the stuff you do understand. And when you are wrong, you have rules that says as soon as that thing is down 10%, I'm going to step in and start risk management. As soon as it's down 20%, I'm out. Risk elimination, right? Whereas the ones that you're right on, you let them perform. Again, each decision you can be right or wrong. That's when you say let your winners run, it's always like, well, what if they turn around and run away from and run the other way? So you buy a stock and it starts going up. Well, at a certain point in time, you have to make a decision, hold or sell. Well, you could be right or wrong on this one as well. And you say, well, I'll hold, and let's say it goes up. Here you got to make that decision again, hold or sell. Well, you could be right or you could be wrong. The idea is if you can be right 70% of the time, right? And then when you make this decision, this becomes your new decision price. As soon as it's down 10%, not 10% from when you bought it, 10% from your decision price, risk management. As soon as it's down 20%, elimination. Hopefully, this is still higher than the price you bought here. These are called decisions. In portfolio management theory, this is called breadth. B-R-E-A-D, breadth. The number of decisions you make. If you're very good at making decisions, you should make a lot of them. If you're very bad at making decisions, you should make none of them. Do you get that? So most of what's in the Kelly criterion you can find in just general portfolio management. But for this one, you have a probability, your probability of right versus wrong. Look back over the last year. How many times were you right? How many times were you wrong? Let's just for argument's sake, let's say you made 100 decisions. You were right 50% of the time and wrong. So you have 0.5 minus, and you have a ratio here. It'll be 1 minus 0.5. This is your right-wrong ratio. Down here is a ratio of what is the average amount you make when you're right divided by the average amount you make when you're wrong. And let's say you win 100, you lose 100. This will be 1. This will go to 0.5. 0.5 minus 0.5 is 0. That is saying you shouldn't be playing this game. If you're right 50% of the time and wrong 50% of the time, and when you're right, you win 100. When you lose 100. You just shouldn't be playing. You're wasting your time. Now, you could have a 50-50. You could say, well, I'm right about half the time. However, when I'm right, I tend to make $200. When I'm wrong, I lose $100. I got risk management down, but I suck at my education. I don't know what to pick, right? But I got risk management down. Well, your denominator is 2. Well, 1 minus 0.5 is 0.5 divided by 2 is 0.25. 0.5 minus 0.25 is, look at that, you have a positive number. So you should have some position sizing because you got risk management down. Well, what if you don't have risk management down? Your numerator is still 1, but you're right 60% of the time. This would be 0.4 in here. 0.4 divided by 1 is 0.4. You'd have 0.2 saying you should have a position. Now combine the two. Let's say you're right 60% of the time, you're wrong 40% of the time. This is 1 minus 0.6. This will be 0.4 divided by 2. This will be a 0.2. Now you're at 0.3. If you combine them, right? So what is your job? What is the Kelly criterion telling you that your job should be? Number 1, get better at winning. Get better at picking winning trades. Number 2, get better at risk management. That's it. That's it. I have been saying for years, you do not have a portfolio of returns. You have a portfolio of risk. Don't manage your return. Your return will be what your return will be. Manage your risk so that you don't have that one trade that wipes out the last 10, right? That's all that thing is telling you. In that light, it's a good exercise to go through. However, the calculation itself, I would say, what evidence do you have that this is right? What kind of back testing have you done that these sizes are the right sizes? I think it's a nice intuitive exercise to go through because it brings it down to two variables. Now, it doesn't mean that it's easy to win on those two variables, but you know your job is being right more than being wrong and risk management. Right? Let's leave it at that. I'm curious because from what I've read, there's some disagreement in Wall Street and academia about whether Kelly betting can be applied to position sizing when trading to produce alpha. Kelly betting and focus on correlated bets. It seems like a trader investor would have to be able to produce alpha versus buying the market if one focuses on a set of uncorrelated assets. Yeah, I'm not going to go that deep into it. I think the takeaway is what I gave you, and I would leave it at that. KC requires probabilities. Where to get them? Your own history. One can infer from option prices. No. You don't need you don't need any of that for the probabilities are yours. Are what have you done? You made 10 trades last week. How many were right? How many were wrong? Actually, 1 week is not enough. I mean, if you're still holding them, you gotta look at your closed positions, not the ones that are open, because you can take on a position and it can immediately go negative on you, but your time frame is way over here, and then by the time you get to your time frame, it's a winner. So you can't look and say, 2 days after, oh, I was wrong. Well, it doesn't really work that way, right? So look at all your closed trades over the last, 6 months. How many were right? How many were wrong? Of all the ones that were right, what was the average gain that you made? Of all the ones that were wrong, what was the average loss? And there you go. You're ready to go. Watch your latest video, AI and Jobs, First Principles. I have a 2-part question. Do you think it's fair to say that someone who passed his or her CFA Level 3 exam has most likely metacognitive level learning or ability to think? Most likely. I would say most likely, yes. What do you think the very definition or conditions determine if someone is indeed a domain expert in a certain... how confident are you about your knowledge? Let's start there. Are you really, really confident? Because confidence looks like this. All right? You're really confident. You're not very confident at all. This is no experience. This is very experienced. Usually the 20-somethings on TikTok that are very, very confident that they're right, if you ask them, how certain are you? Oh, I'm 100% certain. Okay, well, you're a rookie then. You have no experience. Once you get to about 5 or 10 years experience, you're down here. It's like, okay, I think this is going to happen. How confident are you? Well, because you are aware at this point of how much you do not know and how much can go wrong and how difficult these complex systems are. But then you get to a point where you start specializing, you start focusing on a certain area. Maybe you're just looking at mining companies and you get very good at mining companies. You're about 70% right on your picks. You got great risk management and your confidence level is here. How confident are you that this junior miner is a good takeout target? But you've seen a lot and you think, I'm fairly confident. And because you have the expertise to back you up. That's not a 20-year-old. That's not a 20-year-old over here. These experts here, there is no 25-year-old coming up behind them. You'll start over here, and as you start getting older, by your mid-30s, you're here, your late 30s. When you get into your 40s, you're here. By the time you're in your 50s, you're pretty confident because you are aware of what you know and you've restricted yourself to a particular area that you know deeply. Over here, you're all over the place. You hear something and you think you know it all, right? So if you want to know where somebody is on this chart and they say, oh, Bitcoin's going to the moon, ask them, well, how confident are you in that? The more confident they are and the younger they are, the less likely they're an expert in anything. If they're much, much older and they're and let's just stay with the Bitcoin thing, and they're absolutely certain Bitcoin is going to the moon, then they're just stupid and crazy. They're not an expert in anything other than stupidity. If it's Bitcoin. If anything else, yeah, they're probably an expert in it. But if they're 55 and they've been doing this for 40 years and they still think it's going to the moon, you might want to have a talk with their adult children about getting that person some kind of long-term care because their mind is slowly going, and their whole inheritance will be gone. You know. You mentioned this environment looks like 1999. However, from what I've read about it, the majority of companies back then were unprofitable. Same thing now. Majority of companies today are unprofitable. Many of today's big names that are spending billions on Capex are highly profitable cash machines. Who? Anthropic? No. OpenAI? No. Just XAI? No. Name me a model outside of Meta and Google. And even within Meta, is that division profitable? God, no, it's a cash burn. Even within Google, is their Gemini AI project profitable? God, no, it's a cash burn. So they may be divisions in companies, but those divisions are burning cash. No one's making money at this yet. Only NVIDIA and the data centers and the energy providers. But listen, let's go back to 1849. Here's a good lesson. Go back to 1849. It was the California gold rush. That's why you have the San Francisco 49ers, right? In case you were wondering where they got the 49 from. You know, because the gold miners at the time would call themselves a 49er. When it all went bust, they were the 49ers. And you had, let's just put a line here, and this is where all the gold miners went. There they were. They're all heading to the gold fields, see what they can get. And over here you had a bunch of shops saying, well, you need shovels, you need hats, you need this, you need that. And they were doing incredible business until this all fell away, and then they all went bust. They all went bust. They made a lot of money, and then they went bust. The market disappeared. Nobody wanted to buy any more shovels anymore because the hype was gone, all the people coming, all the claims were staked. All the claims were staked. All the gold was taken out. And then you had to start digging deeper and deeper and deeper and deeper. And many of these people failed. A few stayed, but many of these failed. And most of these, just out they go. But these were profitable, even though many here were not profitable. But today, in the model space, I would be hard-pressed to believe that a single company making the models has positive cash flow. And if it's a company like Meta or Google, the division within Meta is not making any money. It's a cash burn. The division within Google, even Waymo with 250,000 paid rides a week, is not making money. These things are cash burns all over the place. So I don't know about many of today's big names that are spending billions on Capex are highly profitable cash machines. I don't think that's true. And hold massive net cash positions. Again, I don't think that's true. Do you see that as a meaningful difference? It is not a meaningful difference. It is the wrong analogy. Now, if you're trying to say, well, if you look at NVIDIA, if you look at AMD, if you look at these companies that are supplying things to these model builders, sure. But so was Cisco, so was Dell, so was Microsoft, so were all the telecoms. They were all profitable. But those who were staking out their claim on the internet were not. Think of the model builders as staking out a claim on this new level, on this new operating system. And the operating system are the LLMs, right? None of them are making any money. On a related note, have you seen the launch of CME spot quoted futures? They've introduced longer dated contracts priced at spot. What are your thoughts on these? It's not quite true. It is not quite true. Be careful. Let me explain how that works. So let's take a futures contract, a traditional futures contract, and here's the spot price. And let's say that there is 40 points between the futures price and the spot price because let's say we are going out 3 months and there's the futures price. We know that that difference is the cost of carry. And this will expire in 3 months, right? Cost of carry. Well, let's go out 1 day. Let's say that there's, a limited time, it expires. We go out 1 day and we see that the difference between the futures price and the spot price is now 39 points. Well, you lost 1 point in the cost of carry. Would you agree with that? You'd say, of course, I'd agree with that. So you have this other contract now that instead of being priced 40 points above the spot and watching it fluctuate as the spot fluctuates, you have this other contract now that is priced. I'll just put a P, F for forward, priced at the spot. So now you look at it, you go, now I know what the price of the index is because I have a futures contract that's priced at the level of the index. I don't have to say the futures are at 6,300. The index is not at 6,300. The index is at 6,260, right? There's a difference between that. You're quoting the futures, not the index. Well, this here gives you the index. Kind of sounds nice, right? At the end of the day, if you close it during the course of the day, there is no cost to carry. If you carry it over to the next day, it is the price minus 1. This lost a point. This will lose a point. So what happens is it'll still be priced at this, but you'll have a financial adjustment when you close it that will take $1 away from, well, it won't take one. You'll have margin that you have to post at this. It'll take $1 away from your margin. So you're paying the cost of carry anyways. The only difference is you get the spot price that you can see. Now you're trading at spot. You can see the spot price, and it doesn't expire every single month. It expires once a year. That's it. But make no mistake, you are still paying the cost of carry in the financial adjustment every night. If you hold it overnight, there is a financial adjustment, and the financial adjustment is the extent to which the futures premium over the spot has decreased. So if overnight it goes from 40 points, let's say there was an interest rate cut that day and it drops to 37 points, then your financial adjustment will be minus $3 out of your account, please. Because this lost $3, you're going to lose $3. You're not going to avoid the cost of carry. Here, the cost of carry is in the price. Here, it's not in the price so that you can see the spot price, but you're still going to pay it. So, there you go. Those are my thoughts on it, is that you end up in the same place. Does seeing the spot price matter to you? Right? If it does, then there you go. If rolling over your contracts is a big pain in the ass, well, then this will do it. Now, the rolling over the contracts, I think, has some value here, because what if you went with a 6-month contract? Well, it would be priced on whatever the 6-month rate happened to be. Whatever 6-month SOFR happened to be, it would be in here. Well, what if you had an interest rate cut during that period of time? Well, then your futures price would drop, but you paid for it with this rate. Here, you pay for it day by day, whatever the day by day is, right? You still have that financial adjustment based on the front month contract, not like the 6-month contract. But most people play the front month. I want to follow up on your answer to my question from last week regarding volatility and beta being useful for making short-term trading decisions. You asked why I would think historical beta or historical volatility would be a good proxy for future short-term volatility. To provide context, you seem to use beta and volatility when selling options. You reference dollar beta weighted delta in one of your portfolio management videos in your applied option series. Well, dollars are pretty objective. You can see what they are. Delta is pretty objective. If you're holding stock, you got a delta of 1. If you're holding options, it has a delta. And the beta, you can set the beta. It's not carved in stone. You can tell your portfolio manager, your management tool within IB, when you're calculating beta, you could say, I want a 3-year look back period. I want a 5-year. I want a 1-year. I want a 1-year weekly. I want a 3-year monthly. You can tell it what look back period that you want. It's not a perfect scale, but it is a relative scale, meaning that when I look at the dollar delta beta, I can look at it and say, well, I know that's not an exact number. I know it's not an exact number because the beta today, the stock is not behaving like beta should say it would behave. The market's up 1%, but I'm flat. The stock I have has 0 beta today, right? Today. So today when I look at the number, I go, but that's not a right number today. It doesn't matter. You use these numbers in relation to something else. So I would You size things based on dollar delta beta relative to other things that you have, relative to the size of your portfolio, because on a relative basis, if you're weighing everything by a broken scale, it will tell you what's heavier and what's lighter. And that's about it. But it's not exact. Nothing is exact. It's the best that we have, right? Also in the video, taking gains and losses, you calculate a stock's daily standard deviation and use that to determine strike price for selling calls and puts for income. Yep. Are you using these as examples of how you could use beta and historical volatility? Yeah. As opposed to how you typically determine your target strike prices? Okay, so I see where you're going on this. There is a body of knowledge out there. So if you're going to do something in options, the goal is to give you as many tools as I possibly can, saying here are all the possible tools and all the different techniques that are generally used out there. I don't really use them. I don't really use, I may use 30% of those techniques. The rest is, well, I don't use them, but I'm aware of them. It would be like me being an accounting teacher and teaching you accounting, and you say, do you do this? And I say, well, no, I don't have an international company with subsidiaries with foreign currency. But that doesn't mean I shouldn't teach it. Just because I don't do it, just because I don't have it, doesn't mean I shouldn't teach it. So just because I don't do something doesn't mean that it's not valuable information to have. If I limited it to what I did, it would be rather boring overall. And much of what I do, a lot of it is intuitive. A lot of it is a feel that I have. So today I watched the price action on TLT. I saw it drop to almost 87, and it didn't feel right. I just intuitively, this doesn't make any sense. So I sold 100 calls for 80 cents at the $87 strike. If I had to put it in words, I really couldn't. It was in the moment, just looking at it, it didn't feel right. So I did it. That's hard to do a video around. What rule did you follow? What was the process? So somebody who's inexperienced saying, explain to me exactly what you did, I'd have to say, okay, it's really simple. Go get 25 years of experience. Let's start with that and then come back and see me. Actually, you won't need me after that. So some answers are, look, I don't have the words for it. It's just something I feel. It's just something I know. Don't copy me because I know the risks that I'm willing to take on. I'm aware of what I'm doing because I do have the experience behind me. Don't copy me because I cannot sometimes put some things in words. I'm on the same page. In this article, they have two examples. Poker. Oh, this is the Kelly criterion still. Okay. Oh, last one down here. I ran your market outlook in Gemini for counter arguments. It pointed out that your Cisco NVIDIA comparison didn't take NVIDIA's software ecosystem into consideration. Doesn't matter. The comparison of NVIDIA to Cisco may be flawed. NVIDIA is not just a hardware provider. It has built a powerful software ecosystem that creates high switching costs for developers, making its position much more durable than Cisco's was. Doesn't matter. What it's trying to do, what the LLM is trying to do, is called reasoning by analogy. So it looks at one case, it looks at the other, it says, here's why this analogy is weak, which is the argument it's trying to make, is because NVIDIA has this, Cisco didn't have that. I would argue that's the wrong analogy. The analogy is not the characteristics of the company. The analogy is the characteristics of the ecosystem they find themselves in. The analogy is the hype cycle, is the S-curve they were both on, was the boom in investment followed by the hype cycle, followed by the disillusionment. So it is using the wrong analogy. It's using Cisco as being a different company with different products and services than NVIDIA. Does not matter. It does not matter. If they're in the hype cycle of that S-curve, both of them will produce over capacity. Well, I shouldn't say they will produce. Just the actions of everybody in the market will produce over capacity. And it doesn't matter how good their ecosystem is if there are hundreds of thousands of NVIDIA servers just sitting around doing nothing. Doesn't matter. Doesn't matter. They're not going to sell any new ones. So it's using the wrong analogy. That's what I would say. So run it again with Gemini saying, the analogy, the reasoning by analogy I want you to consider is the technological S-curve that both of them are navigating. And you can also prompt, the more context you give it, the better. If you describe the technology, the first thing it's going to do is look up the technological S-curve. And then if you say the hype cycle, it's going to look that up. And it's going to find a lot of writing that matches those two up. And now that will be the analogy that it looks at. So if you want to know whether or not, or if you want insight as to whether NVIDIA is going to go the way of Cisco, don't compare the two companies, compare the two S-curves. Compare the two hype cycles. Say, what is unique about the AI hype cycle today versus the dot-com hype cycle in 1999 in relation to their respective technological S-curves. Now, if you ask it that, you're forcing it to make an analogy between those two. And I think it will have a hard time. It may focus on, oh, well, the dot-com had to do with the internet. This has to do with AI. You might get an answer that's just really superficial because they don't do well at analogical reasoning. And that takes us to the end of it. It says here, one new message since. If I click on that, no, I don't get any message. So I guess that's the end of it. Okay.